You have probably heard some version of this rule of thumb. Invest for growth when you are young, and shift toward dividends as you get older. It sounds reasonable. It is also, stated this simply, not quite right. And a single counterexample makes that clear immediately. A 28-year-old Canadian who has decided to pursue early retirement by age 45 and is specifically planning to live off portfolio income starting at that age has a meaningfully different, much shorter effective time horizon for needing income than a 65-year-old Canadian who has a large defined benefit pension covering all of their living expenses, does not need to draw a single dollar from their personal investment portfolio for the next 2 decades, and is simply letting that portfolio continue compounding for their eventual estate. By the simple young equals growth, old equals dividends rule, you would tell the 28-year-old to load up on growth stocks and tell the 65-year-old to load up on dividend payers. The actual, more accurate answer, based on each person's specific circumstances, is closer to the reverse. This video replaces the oversimplified age-based rule with the actual factor that determines whether dividends, growth, or some blend of the two is right for you. A factor that correlates with age for most people, most of the time, but is not, in fact, your age at all. If you want to keep your money mindset sharp and learn how to make your capital work for you, consider subscribing to the channel and liking this video. It truly helps the channel grow and teach people about financial education. Now, let's get right into today's breakdown. Here is the vault from the opening. The actual factor that determines whether growth, dividends, or a blend of the two suits your specific situation. How soon you need to draw income from your portfolio, relative to how much time that same capital has left to compound before it is needed. Why growth investing makes sense the further away that need for income sits. As covered extensively in this channel's other content on compounding, time in market, and the only free lunch of diversification, equity growth compounds most powerfully over long, undisturbed periods, and a portfolio that does not need to be touched for withdrawals for a decade or more can fully absorb short-term volatility without that volatility translating into a forced, realized loss. A growth-oriented portfolio, concentrated in companies that reinvest the large majority of their profit into continued expansion rather than distributing it as dividends, has historically captured a larger share of this long-run compounding upside in exchange for a bumpier ride along the way. A trade-off this channel's video on VGT, VCR, and VYM covered directly. Why dividend-focused investing becomes more valuable the closer that need for income sits. As covered in this channel's dedicated REIT and dividend investing videos, dividend-paying holdings provide a tangible, spendable income stream without requiring shares to be sold, which matters specifically and increasingly as the date you need to start drawing income approaches, because selling growth-oriented shares to generate income during a market downturn locks in losses through the sequence of returns risk mechanism covered in this channel's REIT video, a risk that only exists for an investor who must sell shares to fund near-term spending, and does not exist in any meaningful sense for an investor with a long runway before that spending need arrives. Why this reframes the entire question away from "How old are you?" Two Canadians of the identical chronological age can have dramatically different appropriate portfolio compositions if one of them needs to begin drawing meaningful income from their portfolio within the next 2 to 3 years, while the other has 15 or 20 years of runway before any withdrawal is required. The relevant variable is the distance to the income need, not the number of birthdays that have passed. Why age still correlates with this factor, even though it is not the factor itself. For most Canadians, time horizon to needing portfolio income does generally shrink as chronological age increases, simply because most people plan to retire and begin drawing on their savings at some broadly similar point in later life. And most people are not pursuing the kind of accelerated early retirement timeline covered in this channel's dedicated FIRE video. This is precisely why the simplified age-based rule of thumb exists, and why it is not entirely wrong. It is simply a loose proxy for the real underlying variable, one that breaks down specifically and predictably in exactly the kind of edge cases covered in the hook. Your action step. Rather than asking, "How old am I, so what should I invest in?" ask the more precise, more accurate question this segment has identified: how many years remain before I genuinely need to start drawing income from this specific pool of capital? And use that answer, not your age, as the primary input into the framework covered for the rest of this video. For most Canadians, this stage covers roughly the 20s through the mid-30s and is characterized by a genuinely long typical runway, often 25 to 40 years, before any meaningful, planned withdrawal from long-term investments is expected. Why this stage typically favors growth heavily. With a multi-decade runway, the sequence of returns risk covered in Segment 1 is, for most people in this stage, essentially irrelevant. A market downturn occurring in year 3 of a 35-year investing horizon has decades to fully recover and continue compounding before the capital is ever needed, a point covered extensively in this channel's dedicated Time in the Market Beats Timing the Market video. The mathematical cost of holding lower-yielding, dividend-light growth companies during this stage, covered in this channel's Power of Dividend Investing video, where dividends and reinvestment have historically represented a meaningful share of long-run total return, is more than offset for most investors in this stage by this stage's almost complete insulation from the risk that dividend-focused holdings are specifically designed to mitigate. What this typically looks like in practice: a broadly diversified, growth-inclusive core, holdings such as XEQT or VFV, covered extensively elsewhere on this channel, held inside a TFSA to maximize the tax-free compounding runway, with little to no allocation toward defensive, dividend-concentrated holdings like VDC or VYM, covered in this channel's other videos, specifically because the defensive characteristics those holdings provide are protecting against a risk, near-term forced selling, that does not yet meaningfully apply. The important nuance: total return still includes dividends, even in a growth portfolio. As covered directly in this channel's dedicated video on dividends' share of total market returns, even a growth-oriented, broadly diversified holding like XEQT or VFV still receives, and, through DRIP, reinvests real dividend income from many of its underlying holdings. This stage is not zero dividends. It is simply not specifically tilted toward maximizing current dividend yield as the primary selection criterion, the way a dedicated dividend ETF like VDY or VYM would be. The honest exception within this stage, and it directly echoes the hook: a Canadian in their late 20s or early 30s who is deliberately pursuing the kind of accelerated early retirement, targeting retirement within 10 to 15 years rather than the more typical 30-plus, has a meaningfully shorter effective runway than the typical person in this chronological age bracket, and should evaluate their specific time horizon using the Segment 1 framework, rather than assuming this stage's typical guidance applies simply because of their age. Your action step: if you are in your 20s or 30s and do not have a specific near-term plan to draw income from your long-term investments, the default evidence-based starting point covered throughout this channel, a broadly diversified, growth-inclusive ETF like XEQT held inside a TFSA, remains the most defensible approach for this stage specifically, with dividend-focused tilts treated as optional satellite additions rather than a core necessity. Stage 2. Peak earning years and the pre-retirement runway, typically mid-30s to mid-50s, though this is the stage where the Segment 1 framework matters most directly. This is the stage where the runway to needing portfolio income, for most Canadians, begins to genuinely shrink from multiple decades toward 1 to 2 decades, and where the appropriate composition shift begins gradually rather than as a single dramatic switch. Why a gradual rather than sudden shift is the more defensible approach. As covered in this channel's dedicated diversification video, a portfolio's risk and return characteristics should generally adjust smoothly as time horizon shortens, rather than remaining at maximum growth concentration until a specific birthday, and then switching abruptly, because the specific date someone will actually need to draw income is rarely known with the precision a sudden, single-point switch would assume, and a gradual transition reduces the risk of mistiming that single switch relative to an unpredictable future market environment. What this gradual shift typically looks like in practice: an increasing allocation over this roughly 15 to 20-year stage toward holdings that combine the bond cushioning effect covered in this channel's recession-resistant Vanguard ETF video, such as VBAL, blending equities and bonds, alongside an increasing allocation toward dividend-focused holdings like VDY or VYM, covered in this channel's other dividend-focused videos. Not a complete abandonment of growth-oriented holdings like XEQT, but a deliberate, gradually increasing counterbalance as the runway shortens. Stage 3. Early decumulation. The years immediately surrounding the actual transition to drawing income, typically the 5 to 10-year window before and after the actual point of needing to draw from the portfolio. This is the stage where sequence of returns risk, covered in Segment 1 and in this channel's dedicated REIT video, becomes most acutely relevant, because this specific window, the years immediately before and after an investor begins actually drawing income, is precisely when a severe market downturn does the most lasting damage to a portfolio's ability to sustain withdrawals over the following decades. Why dividend income and the cash buffer strategy covered in this channel's FIRE video both matter most acutely in this specific window. A meaningful allocation toward dividend-paying holdings during this specific window provides spendable income without requiring share sales during exactly the kind of downturn that would otherwise force a permanently damaging sale at depressed prices. And this channel's dedicated FIRE video's recommendation of maintaining a 1 to 2 year cash buffer specifically for this same purpose reinforces the same underlying principle covered throughout this video: protecting against the specific, time-bounded risk of being forced to sell growth-oriented assets at exactly the wrong moment. The honest, important caveat for this entire segment: none of this means abandoning growth entirely during these middle stages. An investor who shifts too early and too completely into low-growth, defensive holdings, well before their actual need for income arrives, sacrifices a meaningful amount of long-run compounding for protection against a risk that has not yet become relevant, repeating in the opposite direction the same kind of mismatched timing error covered throughout this channel's behavioral finance content. Your action step. If you are in your late 30s through 50s, explicitly map your own personal timeline to the point you actually expect to begin drawing portfolio income and begin a gradual, multi-year increase in dividend-focused and balanced holdings specifically timed to that personal date, not to a generic, one-size-fits-all age threshold. Here is the segment that most directly explains the second half of the hook's counterexample, because retired is not actually one single stage with one single correct answer, despite how the simplified age-based rule treats it. Version 1, the retiree who is actively drawing income from their personal investment portfolio to fund living expenses. For this specific Canadian, the dividend-heavy guidance most people associate with retirement investing genuinely applies, for exactly the reasons covered throughout this video. Ongoing spendable income without forced share sales, reduced sequence of returns exposure, and the kind of stability covered in this channel's recession-resistant Vanguard ETF video. A meaningful allocation toward holdings like VDY, VYM, or VIG, alongside continued, though reduced, growth exposure, generally suits this specific person's situation well and is broadly consistent with the simplified rule of thumb from the hook. Because for this person, the rule's underlying assumption, a short runway to needing income, happens to actually be true. Version 2. The retiree whose living expenses are fully or substantially covered by other income sources. A defined benefit pension, CPP and OAS together, rental income, or simply a personal portfolio large enough that planned withdrawals are minimal relative to the total, and who is not meaningfully drawing down their personal investment portfolio. For this specific Canadian, the second half of the hook's counterexample, the actual effective time horizon for that specific undrawn portfolio is not however many years they have left to live, but specifically however many years remain before that capital is actually needed, which, for a portfolio being preserved primarily for an eventual estate or for spending many years in the future, can genuinely be 2 decades or more, closer, in practical terms, to the Segment 2 framework than to the dividend-heavy approach most people would reflexively apply based on this person's chronological age alone. Why distinguishing between these two versions matters so much practically. Two retired Canadians of the identical age, both technically retired by any conventional definition, can have appropriately very different portfolio compositions specifically because one of them is actually relying on that capital for near-term spending and the other is not, collapsing both into a single retirement investing category based on age alone, exactly as the hook's example demonstrated, produces meaningfully worse guidance for whichever of the two does not fit the assumed pattern. A specific practical decision tree for any Canadian evaluating their own retirement stage portfolio. First, calculate what percentage of your actual annual living expenses your personal investment portfolio needs to cover, after accounting for CPP, OAS, any pension income, and any other reliable income sources. If that percentage is high, meaning the portfolio is doing most of the work of funding your lifestyle, the dividend-heavy, income-focused approach from version 1 applies directly. If that percentage is low or close to zero, meaning other income sources are covering most or all of your living expenses, and the portfolio is largely being preserved or growing for a future use, an eventual larger withdrawal, or an estate, the longer time horizon, more growth-inclusive approach from Segment 2 may remain more appropriate despite your chronological age, exactly as the hook's 65-year-old example illustrated. Your action step. If you are at or approaching retirement, calculate the specific percentage figure described above. How much of your actual spending needs your personal investment portfolio specifically must cover, versus how much other income sources already handle? And use that percentage, rather than your birth year, as the primary input into how dividend-heavy or growth-inclusive your retirement stage portfolio should actually be. Let's come back to where we started. Invest for growth when you are young, shift toward dividends as you get older. A rule of thumb that sounds reasonable and breaks down immediately when tested against a 28-year-old pursuing early retirement and a 65-year-old whose pension covers everything. You now have the actual accurate version of this framework. The real driver is not your age. It is your specific, calculable time horizon to genuinely needing income from a given pool of capital. In your 20s and 30s, with most people's runway stretching multiple decades, growth-inclusive holdings like XEQT generally make the most sense, with dividend exposure present but not the primary selection criterion. Through your late 30s into your 50s, as that runway genuinely shortens for most people, a gradual, multi-year increase in dividend-focused and balanced holdings becomes increasingly appropriate, specifically timed to your own personal target date rather than a generic age threshold. In the years immediately surrounding the actual transition to drawing income, dividend income and a cash buffer both protect against the same acute sequence of returns risk. And in retirement itself, which is not one single stage, but at least two genuinely different versions depending on whether your personal portfolio is actually funding your daily spending, the right answer depends on a specific, calculable percentage, not your birth year. Age is a loose, convenient proxy for the real variable this video has identified. It is convenient precisely because it requires no actual calculation. But for the specific Canadians whose circumstances do not match the typical pattern, the early retiree, the pension-covered 65-year-old, and everyone whose situation sits somewhere in between, that convenience comes at the cost of accuracy, and the actual calculable time horizon framework covered throughout this video is what should guide the decision instead.